Hi, welcome to valuationpodcast.com, a podcast and video series about all things related to business and valuation. My name is Melissa Gragg, and I'm a company valuation expert in St. Louis, Missouri. During this episode, we will discuss what happens in an IRS tax audit, tips on how to avoid an IRS audit, and what to do if you are audited, specifically pertaining to estate and gift tax valuations. We have the privilege to discuss these issues with a former IRS auditor, Mike Gregory. He's a mediator in Minneapolis, Minnesota, author of 11 plus books regarding various valuation topics, and creator of the collaboration effect. He's a frequent speaker at estate planning council events and uses mediation techniques to de-escalate situations. There is one book that is titled Business Valuations and the IRS, 5 books in one. What does that start to cover, having to do, because some of these valuations will go into U.S. tax court and they'll kind of be fought because the IRS disagreed with something in the valuation. But what does this particular book kind of cover?
Well, there are 5 parts to the book, and it's huge. It's 852 pages. It has 38 examples. It has 180 practical pointers. But the first part of the book talks about the IRS, how it's organized, how it does classification, a whole bunch of insight into how the IRS works. And then there's another section that talks into how to work with the IRS. So that's a whole different avenue. What would you do for estate and gift that we'll talk about here? What would you do in corporate? What might you do in partnerships? In each of these, you have to realize the IRS is 14 different divisions, and they reorganized in the year 2000, and they've been in stovepipes ever since, and they don't talk to each other. So when I get a call, and someone asks me to help, I first have to identify what type of return are we working with. That will tell me the division that we're in. So let's just say estate and gift. That's in the small business self-employed division. That's a program within that division. And then I want to know, who is the IRS estate and gift tax attorney? That's the agent. And where are they located? And who's the manager? And where are they located? And then I want to know, do you have a business valuer, if there's a business valuation involved? And who are they and where are they located? And who's the manager, called the engineering manager of that person? And where are they located? Because we have different cultures within the IRS, within the division, and then also geography. So even though the IRS has a mission statement to provide top quality service by helping taxpayers understand and enforce the tax laws with integrity and fairness to all, that's a lofty mission. The reality is, if the case is in LA or San Francisco or Kansas City or St. Louis or in Manhattan, each of those locations is going to handle that estate and gift tax case a little bit differently. In some places, you get a lot more agreed cases. Some cases, they'll use the valuers more. Sometimes they use the valuers less. Sometimes they use the valuer as part of the negotiating tool, and they kick out the valuer, and the agent and agent's manager will work to try to resolve the issue. There are different ways in which the IRS might handle it. It's not consistent. So having insights into those, having run the engineering program nationally, I get it. There are 31 different managers in the engineering program. And I get it. They've reduced 350 to 200 employees. So they're supposed to close out more cases with less employees, and they have eliminated the quality review process as a way to save time. That means there's a lot of quality issues that need to be addressed, but you don't attack. I look at it as, I'm not out to attack. I'm out to do all the research I can on that agent and on that valuer, social media and otherwise, and find a way to connect with them. And then I want to ask them, what did they do and why? And given they cut training costs by 95% between 2011 and 2018, they started to bring them back in 2019. That means they're not up to date. You know, you don't do things the same way you did them 3 years ago, let alone 9 years ago. So there's a lot of education that's needed. So ask them what they did and why, and then don't attack. I've watched some of my peers on some of their blogs, and they talk about the mistakes the IRS valuer did, and like, what a dummy. And I'm like, I'm not looking at it like, what a dummy. I'm looking at it as, okay, I see why you did that in that way, but let me show you something else. And I'm going to give you extra, and they will give citations. They said, well, we gave them citations to articles. I'm like, give them the article. Give them your spreadsheet. Show them what you did and why. And as you do this, they're not dumb people. They just aren't educated. That's a difference. So They're not stupid. They're not dumb. They're just not necessarily always educated. So educate them. That's part of listen to them first, see what they did and why. And then you're going to educate judiciously to say, well, are you even aware of this? And let me show this to you. This is how we do things today. And that's a aha moment and can often work to help you resolve the issue with the IRS.
Well, and I think that I was just talking to somebody the other day about this, is that, you know, early in your career as a valuation expert, you're like, there's a right and wrong way to do valuations, and you believe that. And then you start going and progressing through your career. And what I like to say is there's a right way and there's a righter way. And so it's really just, you know, most of the time when we as business valuation people, we create a valuation that we believe is right. And we've done the research to kind of back it up.